Assalamualaikum and salam sejahtera. Hi everyone. So this video is prepared for the additional note that I missed out when I prepared the notes for topic 4 for the first time. Alright, so I have explained to you about the inventory, alright, but I did not put them properly in the notes, alright. So this video is prepared, okay, for the explanation of the ledger entry for inventory, alright, for discounts, right, and also for the carriage expense. Okay, I have explained to you indirectly, but I did not put it properly in the notes. All right, so I have prepared for you an additional notes. Okay, but if you did not download yet the notes, okay, from the U Future, okay, so I have edit the notes and then I have uploaded the latest one. Alright, okay, so ledger entry for inventory. So ledger entry for inventory, this is where we record the movement of inventory. Alright, we are recording the inventory that comes in and the inventory that goes out. Alright, okay, however, for the inventory, we did not prepare, or we did not open an inventory account. Alright, instead we prepare purchase for inventory that comes in, and then we prepare sales account for the inventory that goes out. Alright, okay, alright, so for any purchase of goods, alright, for any purchase of good, okay, for the inventory that comes in, alright, we are going to record in purchase account. Alright, so what will be the journal entry? So when you purchase the goods, okay, so the journal entry would be debit purchase. So why we debit purchase? Because purchase is one of the expense account, alright, and it increase the expense. So when it increase the expense, you debit purchase. Alright, and then you credit, okay, depending on how you purchase. Is it on cash or on credit? If it is on cash, okay, if you pay by cash, then you credit to cash account. If you are using check, then you credit to bank account. If you did not make any payment, you purchase on credit, then you credit to account payable. Okay, then you credit to account payable. Alright, okay, alright, okay. So what I want to focus here is on the purchase account. Alright, on the purchase account. Okay, so this is what happened. You debit purchase, meaning that you open a purchase account. So yes, we have purchase account. Alright, and then you record the purchase of goods on the debit side. Alright, to record an increase in purchase, that is purchase of goods. Alright, in purchase account also, we may record decrease in purchase. We may record decrease in purchase. Why do we have decrease in purchase? Because of drawing of goods by the owner. Okay, because of drawing of goods by the owner. So how do we prepare the journal entry when there is a drawing by the owner? Okay, let's say for example the owner took goods for personal use. Alright, the owner took goods for personal use. Okay, so when the owner took something from the business, goods, okay, either goods or cash, okay, we are going to record that in drawings account. Alright, so drawing account is one component of equity. Alright, but drawings account decrease the equity. Okay, drawing account decrease the equity, so that's why for drawings, okay, so we're going to record that. Okay, decrease in equity, decrease in equity, you debit. Okay, which equity account to be debited? Drawing. Okay, you debit drawings. Okay, and then you credit. If the owner took goods, then it will reduce your purchase. So purchase and expense, you credit purchase. Okay, you credit purchase. If the owner took cash, okay, if the owner took cash, right, then you credit to cash account. Why you credit to cash account? Because cash is asset, asset will decrease because of that, so you credit asset account. Which asset account to be credited? Cash. Alright, okay, so to record a decrease in purchase, okay, you credit. Alright, that is drawing of goods. Okay, drawing of goods, and then you prepare another account for drawings. Alright, okay, alright, what about the inventory? Okay, that goes out. All right, what about the inventory that goes out? Okay, that one is why our inventory go out. That is because of sales. Okay, you sold goods to the customer. You sold goods to the customer. So basically in sales account we only record sold of goods. Okay, we only record sales, okay, which is sold of goods to the customer. All right, so what will be the journal entry when we first record the transaction, okay, of selling goods to the customer? Okay, so when you sold goods to the customer, what happened? Your sales increase. Okay, sales is revenue. Right, so increase in revenue you credit. So which revenue account that we want to credit? Sales. All right, and then debit. All right, depends. If okay, sales was made on cash basis, all right, so and you receive cash, then you debit to cash account. If you receive check, then you debit to bank account. If it is on credit, then you debit to account receivable. Okay, credit sales. All right, so we are focusing only on sales account. Okay, so credit sales, so we have here sales account. All right, on the credit side, then you record how much sales for that day. All right, record sales for that day. Okay, all right, so next, sometimes, okay, sometimes after we sold goods to the customer, right, or after we purchase goods from the supplier, so what happened? We notice that the goods are it is a damaged goods. All right, it is a damaged goods, or the goods that we order, okay, the goods that we order were different from the one that we received. Okay, so what happened? Okay, if we purchase, then we are going to return. If it is the good that we sold, the customer find that it is different from the order, or the goods are damaged, right? So what happened? They are going to return to us. Okay, so we may have purchase return and sales return. All right, so for purchase return, this transaction will decrease this transaction. Okay, purchase return, or we call that return inward. Okay, this transaction will decrease the expense. Okay, when you purchase the goods, your expense increase. When you return the goods to the supplier or to the seller, what happen is your expense decrease. Okay, all right, so when your expense decrease, you have to credit. Okay, which expense account that we need to credit? We did not credit to purchase, we credit to purchase return. Okay, we create a new account called purchase return. All right, when there is a return, we create purchase return. All right, depending on how we purchase, okay, for the first time, if you purchase on cash basis, okay, when you return the goods, okay, you receive cash, so it will increase. So there will be an increase in asset. Okay, if all right, if you purchase, okay, if you purchase, all right, or if you purchase on credit, all right, if you purchase on credit, you did not pay the money yet. All right, okay, so what happened is at that time you create an account, okay, for liability. All right, you create a liability account called account payable. All right, so when you return the goods, what happened? Okay, there will be a decrease in your liability. Okay, decrease in your liability. All right, so decrease in expense, you credit purchase return. Increase in asset, okay, if you receive cash, then you credit cash. If you receive check, okay, so you debit bank. All right, if it is a decrease in your liability, then you debit account payable. All right, but we are not going to focus on this one. We are going to focus only on the purchase return. Okay, so the credit purchase return, so meaning you open an account for purchase return. All right, and then you credit. Okay, you credit the amount. All right, to record goods return to supplier or seller. Okay, all right, next. Okay, all right, what if, okay, our customer return the goods? Okay, what if our customer return the goods? Okay, because the goods it could be due to damage of goods. It could be due to wrong specification of goods, okay, or it could be any other reason. All right, so the customer return the goods. All right, so when the customer return the goods, okay, to the business, so what happened? Okay, decrease in sales, so decrease in revenue. Okay, so when the customer return the goods to you, right, when the first time the customer purchase from you, okay, the customer pay money, so you have to return their money. So when you return their money, what happened to your asset? Your asset also will decrease. Okay, if the customer purchase on credit, what happened to his or her account? Okay, account receivable, so you have to deduct from his or her account receivable, so again there will be decrease in asset. All right, but this one is for cash or bank, okay, or if it is on credit, it could be account receivable. Okay, you prepare an account receivable. Okay, so decrease in account receivable. Okay, so decrease in revenue, we debit, so debit. Okay, but we are not going to debit sales, even though it is a decrease in revenue. We are going to debit to sales return. Okay, debit sales return, and then credit, right, depending on the situation that I mentioned just now here. Okay, you could credit to cash. Okay, it could be cash, it could be bank, or account receivable. Okay, so all you have to do is to check again the previous transaction that we have with this customer. Okay, so we're going to focus on this one. Alright, so meaning you are going to prepare sales return account or return inwards. Okay, alright, and then you debit the amount, okay, to record the goods returned by customer. Alright, so here, okay, you did not say to record goods by returned by customer or buyer. Okay, so you have to state, if it is cash, then you're going to state here cash. Okay, if it is bank, then you state here as bank. If it is account receivable, you state here as account receivable. Similarly for this one, okay, if you receive, okay, similarly for purchase return, okay, so when you record the amount here, alright, here you do not write it down as to record goods return to supplier. You write the particular, okay, either as cash, bank, or account payable. Okay, pardon my bad handwriting. Alright, cash, bank, or account payable. Okay, so that is how you prepare. Or at the end of the day, what happened? You have to balance off the account. So when you balance off the account for purchase return, you will have a balance CD on the debit side. This is credit balance. Okay, and then for sales return, you will have balance CD, okay, on the credit side. So this is debit balance. Alright, for sales, okay, for sales, we balance off the account, so we have balance CD on the debit side. Alright, so this is credit balance. Alright, and then for purchase, it is common that, alright, we have balance CD on the credit side, so this is debit balance. So this is what happened at the end of the month, at the end of the day, at the end of the year. Alright, when you balance off your account. Alright, okay, so let's look at the next one, discount. Alright, so there are basically two types of discount. Alright, one you have to record, the other one you don't have to record. Alright, so we have here trade discount and cash discount. Okay, trade discount is due to, okay, bulk purchase. You receive trade discount because you purchase in bulk, you purchase many, okay, compared to maybe only few or one. Alright, so if you purchase many, you receive bulk, you receive trade discount. Okay, let's say for example, if you purchase one pen, okay, it costs you 1 ringgit. But if you purchase 10 pens, it costs you 9 ringgit, meaning that there is a trade discount of 1 ringgit if I were to purchase 10 pen. Alright, or per pen, okay, I receive discount for 10 cents. Okay, so trade discount is given to encourage bulk purchase. Alright, okay, so when we make a bulk purchase and then when we make the payment, alright, we are not going to pay the full amount of the purchase. Okay, we are going to pay only the net amount, okay, after they deduct the trade discount. Okay, for example, if I purchase 1 pen, I have to pay 1 ringgit. But if I purchase 10 pen, okay, I receive a trade discount of 1 ringgit and I pay only 9 ringgit. So when the cashier register the transaction, okay, when the cashier record the transaction, okay, it is recorded as 9 ringgit. It is not recorded as 10 ringgit. It is already deducted from the total selling price, and hence, okay, trade discount are not to be recorded. Okay, trade discount are not to be recorded, okay, in the books of accounts. Okay, not to be recorded because you receive the discount on the spot. All right, when you make the payment or when you receive the invoice, if it is on credit. All right, if it is on credit, when you receive the invoice, it is already deducted in your invoice. Okay, if you receive the receipt, it is already at the net selling price. Okay, so trade discount is not to be recorded in the books of accounts. So if you have any transaction talking about the trade discount, all right, so when you prepare the journal entry, you have to show the net amount. Okay, you have to show the net of trade discount in your books of account. All right, okay, and then we have cash discount. All right, so why do we have cash discount? This is to encourage prompt payment of credit sales or purchase, to encourage prompt payment or early payment, because when we sold goods on credit to the customer, all right, we would like or we would love if the customer pay earlier. Okay, so what can we do is we can offer, what can we do to encourage them, okay, to pay earlier? So we can offer them cash discount. Let's say, for example, if you pay within 30 days, okay, you get discount of 5%. Okay, so if the customer is wise enough, maybe the customer will make a payment within 30 days and then receive 5% discount. All right, okay, similarly for purchase of goods, if we purchase goods on credit, all right, there is a possibility that the supplier will offer us a discount if we make an early payment. Okay, let's say, for example, if you pay within 30 days, then we are going to give you a discount of 3%. So if we wise enough, maybe we take up the offer. All right, maybe at the end of 30 days, so we are going to make the payment and then we receive the discount. All right, okay, so this discount, cash discount, all right, is to be recorded in the books of account. Why? Because, okay, when we make the purchase or when we sold the goods, all right, for that business transaction, we recorded the amount of sales and the amounts of purchase in full, okay, without any discount. All right, but then when they make the payment, let's say, for example, the customer make the payment within the credit term, okay, with discount, all right, so we have to deduct from our account. Okay, we have to show a deduction in our account due to discount allowed or discount received. Okay, all right, so this is to encourage prompt payment of credit sales or credit purchase. Okay, so for sales, okay, we have sales discount or discount allowed. All right, for purchase, we have purchase discount or discount received. Okay, all right, so what is the effect? If you are required to talk about the effect to the accounting equation, all right, sales discount will definitely decrease your revenue. All right, and at the same time, it will decrease your asset because you have to show a deduction in your account receivable. Okay, similarly for purchase discount, it will decrease your expense. Okay, and then it will decrease your liability because you don't have to pay as much as, okay, the amount stated in your account payable when you make the purchase for the first time. All right. Okay. So what is the journal entry? So decrease in revenue, meaning that we have to debit, all right, but we're not going to debit to sales, even though this is a decrease in sales. Okay, we're going to debit sales discount. Okay, and then decrease in asset, which asset? Account receivable. So debit, discount, credit, account receivable. Okay, for purchase discount, how to record this one? Decrease in expense. Okay, decrease in expense. Okay, meaning we know that this is a decrease in purchase. Okay, so decrease in expense. Okay, so credit. All right, but we are not going to credit to purchase directly, but we are going to create a new account called purchase discount. So credit, purchase discount. All right, and then decrease the liability. We have to show a reduction in our liability account because of the discount. All right, so debit account payable. Okay, so for sales discount, for debit sales discount, credit account receivable, you deduct the amount of discount. You show the amount of discount. All right. Okay. This is to record the amount of discount that you receive or that you allow to your customer. Okay. Next is carriage expense. Okay, so carriage expense, we have two types of carriage expense. The first one is carriage inwards, the other one is carriage outwards. Okay, what is a carriage inwards? The cost of transporting the goods from the supplier or seller to the business premise. Okay, from the seller to our premise. Okay, so this carriage inwards will be treated as cost of sale or cost of goods sold and will be added to the purchase cost. Carriage outwards, okay, is the cost of transporting the goods from business premise to the customer, okay, or buyer. So this one will be treated as an operating expense. Okay, both are expenses, but one is to be treated as cost of goods sold and the other one is to be treated as operating expense. All right, so the effect, okay, so the effect of this treatment, okay, can be seen in the statement of profit or loss. All right, okay, so that's all. All right, for the explanation. All right, for additional note of topic 4. Thank you.